India's risk-free rate has considerably come down.
जो अच्छा है ना वो महंगा ही होगा.
India's growth prospects for next 5-10 years appear to be marginally better than the last 10 odd years.
Longer the growth, higher the valuation. Higher the growth, higher the valuation.
Biggest mistakes I have made in life is not buying stocks just because they looked little expensive in the very near term.
Last few years, I think consumption has been supported through EMIs and through rising household leverage.
Very good afternoon. This is a session with market gurus, and is actually it's a privilege on my part to have this opportunity of interacting with these three distinguished market gurus. I won't get into describing what they have achieved in their careers, in their investing journey. Ridhima already has listed them out. What I would like to do is in the next 45 minutes or so, we would like to delve into this critical question of is the India premium justified? Now, historically, this has been a question that the Indian market has a premium which is not justified. Is it more than justified or not? So what I would like to do with Mr. Jain, Mr. Khemka, Mr. Singhania, is that in the first round, we'll try to demystify whether the Indian market, the market premium is really justified or not. And also get into the debate of how do you define a premium? Because there is this view that we are, high premium, may not justified or not justified. So let's get into the nitty-gritty of it in the first round, and then we'll go into the specific issues that concern the Indian market. We'll keep in mind the US developments that happened yesterday and will play out. So since you are closest to me, Mr. Jain, let me start with you. How do you see this thesis that the Indian market premium is not justified, or is it justified, and why so?
Thank you, Mr. Bhattacharya, and a good evening to all of you friends. And I think this is a very topical issue, and the PE multiples of Indian markets are indeed about 20-30% higher than longer term averages. And this has resulted in an expansion of the premiums of Indian markets over other EMs also. I think to a large extent this is justifiable because two things have changed in India. One is that India's growth prospects for next 5-10 years appear to be marginally better than the last 10 odd years. So I think given the supportive external environment, which is conducive for higher growth in offshoring of services, and also over time growth in manufacturing, plus a lot of improvements that have taken place in India by way of reforms over last 10 years, I feel India's economy should grow maybe 1% or so higher in the future. The second more remarkable change is in the cost of capital. If you look at India's decadal inflation over last 4 decades, every single decade the inflation has moved lower. And as a result, the gap between Indian and US 10-year yields is running quite low by historical standards. It is between 2.5% to 3% right now, compared to 4 to 6% gap in the past. And as you know, PE multiples are inversely proportional to K minus G, K being the cost of capital and G being the growth. So K minus G I think has reduced by 1 to 2%. So I think we can justify 15, 20, 25% higher multiples of Indian markets.
So that adds to the earnings growth.
No, PE multiples is basically inversely proportional to 1 upon, or one of K minus G, the higher the growth and the lower the cost of capital, then fair multiples tend to go up. So I think we can justify 20, 25, 30% higher multiples compared to the past. And that is where we are trading at. So to a large extent, I think these premiums are justifiable. Also, we must note that India's return on equity is meaningfully higher than most other emerging markets. So, but at the same time, I feel there is very little room for PE multiples to move up in these markets. So our return expectations have to be more moderate, but more on that later probably. Thank you.
Okay, Mr. Jan is positive. He says that the premium is justified, looking at the Indian economy's growth prospects, looking at the capital cost coming down. But the long term, the scope is probably limited. Did I interpret you correctly?
Yes, for multiples to move up, I think bulk of the return should come from earnings growth. That's what I was saying.
So it's a qualified comment where they are justified, but further growth is not probably on the horizon. Mr. Khemani, your take on it.
So I broadly agree with what Prashant has alluded. You know, any asset class valuations are function of only three things, right? The yield, growth in yield, and cost of capital or discounting rate, right? So in case of equities, yield is ROE, right? So which is whether you compare to the historical time or compare to any other market at 15.5, 16%, it is one of the best in the market. Nowhere else you will have that kind of ROE. Growth in yield is earnings growth, as Prashant was saying. So broadly speaking, most pessimist person will be around 15%, optimist will be around 20%. But that's the broad range of earning growth. I don't think any other market, is offering sustainability or confidence in the growth over next, 5, 10, 15 years. That's the kind of promise India has. So that's the second thing. Third is the discounting rate, which is a function of risk-free rate and risk premium. And if you see, India's risk-free rate has considerably come down. Difference between 10-year US and 10-year India is like hardly anything. It's lowest all-time low. And risk premiums are coming down. So I think we very often understand the change in the discounting rate in case of a fixed income very easily understood. That what is the change in the discounting rate has an impact on the valuation. A 2% drop in a discounting rate for a 10-year GSEC we understand 12% appreciation, right? But in case of equity, a 2% drop in the discounting rate expands equity valuation by everything else remaining same by 30-35%, right? That's the kind of, so if earlier, let's say hypothetically speaking, 20 PE was there, 26, 27 PE also become normal with the just change in the discounting rate of any asset class, in this case equity. So I feel that as India is getting repaired or has got significantly repaired and is getting further repaired, as it is getting more and more organized, our tax collections are going higher, as more and more economy is getting formalized, our corporate profit to GDP will keep on expanding. Last time it peaked around 6.5-7%. I think it will further go to 8-9%. So as that happens, you will see more and more earning growth happening and expansion happening in the further premium. I would probably will not give you a qualified comment. I would say that probably over next 3, 4, 5 years, you will see further expansion in equity premium. And another parallel of this is very much similar to what happened in Japan in 1965 to 1989, where Japanese economy went through a significant transformation. 1945, Japan was kind of broken, and 20 years it took to repair, but 65 to 89, Japan had what we call Japanese economic miracle. In that, significant multiple expansion happened, right? At the peak of the market in 1989, Japan as a single largest market was, as a world market cap, Japan's market cap as a percentage of the world market cap was 43%. Nikkei peaked at the PE of 60 times. Okay. So I am not saying whether Nifty will go to 60 times PE, but point I'm trying to make is whenever any economy goes through a transformative phase, and it is one of the only story around the town, if you see globally, there are very few markets where you can see a sustainability of the growth, sustainability of a structural growth for a very long period of time. More money chases that market and it gets re-rated. So in my opinion, I would dare say that I don't know whether it will happen next 2 year, 3 year, 5 year, I don't know that, but we will see a significant multiple expansion of the markets from here. It could be 35, it could be 40, I don't know. That's anybody's guess. But I see a significant expansion happening from here based on these logics.
Oh, so lovely. I think, so what Mr. Jan said, he qualified it a little bit, but Mr. Khemani has given almost a clean chit, saying that sustainability is a big issue, risk premium coming down is a big issue. So therefore, India's market premium is not just justified, but actually he sees an upside to it going forward for the sustainability factor, for the future growth, and is one of the biggest, potentially the biggest markets that he sees in terms of premium. Mr. Singhania, given the two have slightly differed, not substantially, but in nuancing, I would say, what would be your take? Will you take this perception to a different level, or do you want to sort of strike a middle path? Mr. Singhania.
Thank you for having me. So while I'll more or less concur with my two friends who are on the dais with me, see few things. One is only P cannot be an indicator whether something is expensive or cheap. Otherwise, you don't need any of us. You can every day calculate P and then buy or sell. You don't need fund managers, you don't need anything else. So P in isolation cannot be the only factor. Yes, it is important. And as value conscious investors, obviously it's a important, I would say, one of the factors which you have to consider. But if I look at my own professional journey, and I've been reasonably successful, but the biggest mistakes I have made in life is not buying stocks just because they looked little expensive in the very near term. I think जो अच्छा है ना वो महंगा ही होगा. There are so many beautiful ladies in the crowd. All of you all have bags, right? Now some bags are 5,000, some bags are 5 lakh. Now if you just go by the PE multiple, then LV bag should not be sold at all. So जो अच्छा होता है ना वो महंगा ही होता है. And I think at this point of time, India is at अच्छा in a world where nothing else is closer to acha, and if you look at the transformation, from being almost zero in 1947 to $1 trillion in 2007 to 2 trillion in 2014 to 3 trillion in 2022 to 4 trillion in 2024-25 and maybe going to 8 trillion in 2031-32, I think there is no competition as far as that is concerned. And therefore, I think just to say that P is expensive and therefore, this is not a market to invest, we will make the mistake which we have made for so long. The only one thing is when you are coming in equity, unfortunately, everyone has a sort of, I would say a little bit of greed that we want to make 30-40% return every year. Some want even in a weekly basis 30-40%. But most of the investors are looking at 30-40% every year. That is not going to happen forever. And I think if your return expectation, as Prashant mentioned very rightly, that if your return expectations are in line with the profit growth of the underlying companies, then there is no need to get worried at 19-20 P. And we are not like at 35-40 P where markets have gone up earlier where there was complete euphoria. And therefore, I think we are pretty comfortable. The other thing is that the nature of the economy in the market is changing dramatically. We are not in the traditional old manufacturing and asset-heavy companies whose Ps were low. We are in very knowledge-based companies, in faster-growing companies, where traditionally, globally, the P multiples are higher. And therefore, looking at the way the whole country is transforming, I think it is very logical that the composition of the market, the composition of the indices will gradually change, and that will call for slightly higher P. So, while completely agreeing that we are not as cheap as we were earlier, I think returns will definitely be made. And I will repeat again, जो अच्छा है वो थोड़ा महंगा होगा ही.
But Mr. Singhania, you also said that return expectations need to be tempered a bit. I mean, does that mean that you are siding with Mr. Jan
No, I think if
and
you
leaving
see-
Mr. Khemani alone?
If you see the longer term returns for Indian markets, they have been around mid-teens. And that will continue. So we are not tempering the returns. We are just saying that have reasonable return. Don't come with expectations that last year we have made 30%, so even in the future we'll make 30%. You will make on long-term returns, and see, ultimately when you are investing in equity, you are becoming a partner in the business. So the returns when you are a partner in the business is equal to the profit growth you make. And those are the returns we'll make. I don't think you should say that we will temper the returns or not. I would say we are only suggesting that you should be comfortable with the long-term average returns which equities give.
Okay. So, when you said that returns expectations should be tempered, what could be the downside and what could be the upside?
One is, again, I said, this word tempered is not the right word. Just
Okay.
saying that returns should be reasonable compared to the long-term trend. See, when you're investing in an asset class, obviously, equities, I always say, are like cardiogram. Cardiogram upar niche hota hai, we are alive. I think markets are also like that. They are always going to be up and down. Yesterday they went up, today they are down, maybe tomorrow they will be up again. That is the way the markets behave. Now, if you are wanting fixed returns with no upside and downside, then there are a lot of bankers, they will give you fixed deposits of 5, 6, 7%, where the government of India is your partner to the extent of 40%, so you'll be left with 4%. There will be no downside, no upside. If you are looking at equity returns, if your horizon is 5 years, there is no downside. If your horizon is 5 months, maybe there is some downside. If your horizon is 5 days, maybe there might be bigger downside. So the upside and downside is dependent on what your horizon is. But if you're looking at it from a 4-5 years perspective, our view is that there is no downside. You will end up making your mid-teen returns for sure.
Okay. You explained it very well. Mr. Khemani, you talked about sustainability. Can you come in on a little more about this sustainability factor? Because explain to this audience, why do you think that sustainability is such a big issue? And how do you think the sustainability factor get influenced in the marketplace? In a sense, what are the factors that an investor needs to be cautious, needs to be mindful of to assess the sustainability factor?
No, I think, see, we are talking about the country level. So, of course, whether when you invest into any country or any company for that matter, you assess that, how long this growth can sustain. And so longer the growth, higher the valuation, higher the growth, higher the valuation, right? So these are the two factors which go very well in the valuation of this, right? So at a country level, if you see, the major structural repairs have happened, right? Historically, if you see, there are 4 or 5 factors where the risks have come from in India. One, this is whenever you see our current account deficit or external account gets imbalanced, we become weak. So whether it was 1991
That's
or
right.
2012, we became part of fragile 5 because our current account deficit went to 4.5%. Right? Today, with a lot of government initiatives and all those things, current account deficit will come to around 1%, and in next 4, 5, 7 years, I think it's going to become surplus account. So that repair has happened. In 2012, when the fragile 5 happened, taper tantrums led to 20% depreciation in the currency. This time around, US has raised interest rates by 5%, but our currency is holding very well. So that repair has happened. Second risk always comes from looking at fiscal deficit. Again, we are one of the best managed fiscal deficits around the globe. Tax collections have been going up. I don't need to be, telling this audience, everybody knows about it, right? Third, whenever banking system goes into trouble, right, it has implications on the economy and corporate profitability. This time around, if you see, our banking is one of the best in the health, whether it is asset quality, ready to grow, well capitalized. Again, probably I would say the best in the world, right? So that again is solid. Fourth is inflation. Our country has managed inflation so well. I think most countries are struggling, but we have done very well on that. And lastly, our corporate debt to GDP or debt to GDP or household debt to GDP.
That's
Again,
also-
we are one of the, very, very solid. So if you see, our 5 structural points which have historically brought volatility to the corporates earning or markets are right now in a pink of the health. And hence it looks like that over next, and thanks to lot of initiatives, reforms being done by the government. So that looks like that over next 5, 7, 10 years, these are going to carry us out in terms of having a sustainable corporate profit growth. And other way to think about it, just think about it. Like I said, in 2008, our corporate profit to GDP peaked at around 7.5%, right?
Yeah.
That time we didn't have GST, we didn't have a lot of formalization of the economy. I think this time around it can go further higher than that. It could be 9%, 10%, anybody's guess. So if you were just, let's say by 2035, if our economy is expected to be $10 trillion, and take a number of 9%, 10%, whatever, our corporate profits would be around $1 trillion. And even if you take a moderate PE of 20, 25 times, our market cap will be $20 to $25 trillion. And today we are at $5 trillion. So that tells you the kind of extent of opportunity ahead of us, 5 to 25 over next 10, 12 years, right? Which other market can offer this kind of growth in the corporate profitability, which is today around $180, $190 billion, to, so $5 trillion to $25 trillion. I don't think any market in the world has this kind of potential to offer. And that is what I mean by sustainability, and that is what I also believe, that more and more people figure out India. Ultimately, valuation is also a function of two things: earnings growth and liquidity. Earnings growth is solid, and more people figure out India. We will see international flows also coming to India, and that will re-rate India's story further. And we have seen many such examples in the past, in different countries which has happened. So I do believe that sustainability always drives more valuation. And that is my key hypothesis.
Wonderful. Thank you very much for this detailed explanation on the sustainability issue, which sort of cleared up many of the doubts. And, Mr. Jain, let me come to you. Mr. Khemani talked about sustainability and largely used what I would call the macroeconomic numbers and the macroeconomic variables. Are there any worries, any concerns that you see in the micro side? Are there any trends that worry you? Macroeconomists often talk about demand being uneven. Macroeconomists often say that probably this is an unequal growth, so therefore, so these micro developments, could they be a kind of a dampener, or should people be little mindful? And the point that you mentioned about how the scope for an upside in the premium is limited, is that something to do with that, or is there something more that you see beyond the micro side?
No, I think, in my opinion, India's growth is sustainable. And as Vikas rightly mentioned, India's current account, fiscal, corporate leverage, and banking NPAs are in extremely good situation. However, the household debt to GDP is not so low. And we are seeing a increase in the NPAs of the small ticket retail loans. Last few years, I think consumption has been supported through EMIs and through rising household leverage. So I would say that the growth in consumption should be moderate compared to expectations. And I am not surprised because the household leverage has indeed gone up. I think the lower inflation is great, but it also means lower growth in rupee terms, and that is why the cost of capital has come down. So GST revenues are now growing around 9% a year. And I don't think they will grow too much, because the catch up from less formalization to formalization has probably happened to a large extent in the last couple of years. So I would expect, and I could be wrong here, and I'd be happy to be wrong here, I don't think the corporate profits to GDP, what India touched pre-Lehman around 7%, is going to be crossed in a hurry. Because most sectors are enjoying fairly healthy levels of profitability. And we have seen even in the last quarter results that virtually no companies have expanded margins. So, and we are not like US, where you have tech innovation driven businesses. So I would say our businesses are more linear in that sense, and upside to margins, to my mind, is quite limited. So I would again go back to the same point that corporate profits, in my best judgment, should grow around 12% CAGR. And I think that is what is the likely return from Nifty over longer periods. I think one additional point what an equity investor should keep in mind is that yes, while India is in focus and a lot of capital is likely to come India's way, both from local sources and global sources, the supply of stock is even larger.
Okay.
So these high multiples are leading to significant dilution. I mean, look at the IPO pipeline, look at the billion-dollar plus issues, that is very large. So I would say this demand for equities is more than demand, it is matched by supply. And I think the supply will keep on rising because entrepreneurs would want to raise more and more capital if you offer them, if you allow them to dilute at expensive valuations. So I would somehow not agree with this narrative that India's PE multiples can go up. I mean, they may go up, but I don't think they will sustain. Yes, it has happened in many other countries. Even in India, it has happened in the past. PE multiples have reached higher levels, but the key is, will they hold on to their, will it lead to sustainable creation of wealth? I think those multiples may not hold. So I would again agree that, suggest 12% CAGR to Nifty is reasonable to my mind. And small mid caps, I would be quite worried because I see a lot of excesses in that space.
So, is that, in other words, are you worried about the micro sector concerns?
No, I don't
Demand.
think there are any concerns. See, demand slowdown is temporary. It will come back. You grow slower for 1 year and your leverage is fixed in retail home loans, and again you will grow. So I think 6-7% growth longer term in economy is doable.
Mm-hmm.
I don't think there are concerns. These concerns of, and you can see the retail loan growth has slowed down sharply post the steps taken by RBI. It is growing out, I think, around 13-14%.
Absolutely.
So I would not worry, but I think the key is to have realistic expectations from these markets in my judgment.
So, and also a very interesting point Mr. Jan raised was that the limited scope for further formalization. In a sense, it has already reached a point where further formalization benefits would be limited. Did I get you right?
See, I don't know. The exact answer is very difficult, but I would assume if you look at the top line growth of companies this year, if you look at the margin expansion, then you are not seeing them growing ahead of the nominal GDP growth. So there is no reason why they should not have grown faster if formalization was further taking place. So I would give lot of weight to the data what we are seeing currently. After all, why are profits not growing in the current year rapidly? If everything is so good, then you should have grown 15-20%, but that's not the outcome.
Okay, Mr. Khemani and Mr. Singhani, I will come to both of you on this issue. Would you like to add to this the perspective that Mr. Jan gave on a slightly nuanced assessment that he gave? Actually, it has become even more nuanced from his earlier, the preliminary statement that he made. Would you like to come in on that, and would you agree or disagree or add to his assessment?
No, I think, see, I completely agree on the point that you should always invest with a low expectation, right?
Yeah.
There's no doubt. Because especially when the years when you have a great return, it is very natural to have high expectation, and then if you raise your expectation, you start taking more risk and stuff like that. But I would probably still slightly,
You are more bullish.
I am more bullish. I am, of course, and probably my sense is that what Prashant's view is little bit more near term or medium term. I am more coming from a long term perspective, because when we are investing into equity, I think we look at 8-10 year perspective. And I have a reasonably, I believe that as India is more and more formalizing today, the work which is happening in MSME, which I think a lot of people, according to me, are misunderstanding. In India, MSME is growing really, really well. And as I see, as this scale up in times to come, more and more formalization will happen. And a lot of formalization has already happened and is underway. And interestingly, what is happening, historically, India did not have manufacturing as a very big base. Today, manufacturing is going to be very big base for India in the times to come.
But it is still very low in
It
terms
is
of
low,
GDP.
but think,
So
yeah,
there
it's
is an
about-
upside, I agree.
It is 16% of GDP today,
Yeah.
roughly about $500-600 billion. But this number, I mean, let's say if you look at target is around 24-25%. Now that number from $500-600 billion going to $2-2.5 trillion is a massive jump. And when this kind of things happen, you obviously have significant contribution coming towards sort of corporate profitability. So again, I mean, jury will be out, and we all see directionally we are all saying same thing, right? Whether it is 12% or 15%, that's the argument, and that I think probably only time will say.
Okay.
It's not. I think what we are saying is structurally India has got repaired. There are lots of positive India. There's no other market like India in the world. Keep low expectations. If you target 12% and 18%, nobody will be complaining. But if you target 18% and 12% comes, then I think there's disappointment, right? So it's always good to do that, and stick to basics principle, avoid excessive valuation, avoid fads. That's the I think point we are making.
Mr. Singhania, your take on it?
So I'll just put forward in a little bit of a different way. So
Yeah.
I think, see, post-COVID, you had a couple of years of super growth. And I think last 1 year, maybe people realized that they have bought more of everything. So a little bit of held back is there in terms of spending, which we are clearly seeing in the first 6 months. Second is a lot of prices have fallen. And therefore, value growth to that extent has got impacted. So if you see a lot of companies, they say that, they have grown in volume terms maybe 7-8%, but value growth is almost zero because prices have corrected. So that is the second thing. Third is our view is that because it was an election year and because there has been a little bit of climatic change, we had a very aggressive summer, and then, the monsoons sort of dragged for maybe 15-20 days more. I think everything has got back-ended. So the proof of whether we should be super bullish or reasonably bullish will be in the results which come out in December and March, because that will actually indicate whether this consumption slowdown is for real or whether there will be...
So till that time, the jury is still out.
Sir, we are always optimistic, and people who have been optimistic in India last 25 years have had good smiles, good health and good wealth. So if you want good health and good wealth, you have to be optimistic on India. But coming structurally, I think India is a young economy. We are, almost like 30 years of median age, and therefore there is no reason for us to believe that the natural growth in India will be 6-7% real and maybe 10% nominal. And I think that is a base level growth of companies' profit. Maybe if you add some efficiency and our little bit of skill in picking some companies, we can inch up to maybe, mid-teen kind of returns. But two things will change this for the positive. One is we are still dependent a lot on many products which are imported. And this whole move towards Make in India and supporting India, electronics is a very, very key indicator. So I think with the same GDP, just import substitution can add a little bit of growth. And second would be the export opportunity. Right now, last 2, 3, 4 years, the world economy is going through a very rough patch, particularly Europe. Even US has not been growing that much. And now with this whole rhetoric of China +1, again resurging with the change in guard in US, it is possible that a lot of Indian products and a lot of Indian companies will be able to make or take advantage of the export opportunity. And it is possible that 1-2% growth also is because of the export opportunity which Indian companies are able to extract. So while agreeing with Prashant that the base level 11-12% growth looks likely, maybe these two things, which is import substitution and some exports, might inch it up to maybe a 14-15%. And see whether the market gives return of 12 or 15 or 20, or whether the PE is 15 or 20 or 25, none of us can say for sure.
Sure.
Ultimately, beauty is in the eye of the beholder. आपको ये बॉटल 10 रुपए में अच्छी लगती है, मुझे 20 में अच्छी लगती है, किसी और को 50 में अच्छी लगती है. Abhi, at least for the next 3, 4, 5 years, PE can be 30, PE can be even 5. We have seen times when PEs have become 8 and 9 also. So I think it's not only about India particularly, but also how the world sort of behaves, what are the equations which come in. It's a volatile world, we have to accept that.
Sure.
There are 40 odd small conflicts and wars going on in the world. something might blow up at some point of time for the negative. On the other hand, the world has not been growing. Suddenly, if growth comes back, you might have an uptick. So I think there are a lot of factors which determine this P. We can only assess what the profit growth can be.
Fair enough. Fair
So
enough.
the best thing to do is expect a reasonable return. ज़्यादा आएगा तो कोई वापस नहीं करने वाला है. You enjoy that, but expect a reasonable return. I think that is the best way of going ahead as far as your long-term investment is concerned.
Okay, thank you. No, I think we have managed to guide ourselves into a further discussion on the external sector, and you were hinting at that. And we have reached a also very interesting stage, and we will come to the audience for some questions from the floor. But I wanted to finish this external sector bit, and maybe I will ask Mr. Khemani that, Mr. Singhania talked about West Asia. I will add to that what is happening in Europe. There is a US regime change. So how do all these factors, and as he rightly pointed out, there are 40 incidents, conflicts, small conflicts across the world. In this kind of a situation, how can you probably be as bullish? Because uncertainty is very large. So, so would you like to respond to the external sector uncertainties and how we should really deal with it from the enjoying the market thing?
I got it. So, sir, I think in my 25, 30 years of career, I don't know any period when there's no uncertainty around, right? Let us look at in last 20 years. We have had 2002, I remember Nifty was 800 points. Today we are 24, 25,000, right? In this period, we had multiple government changes, UPA 1, UPA 2, NDA. We had 2008 financial crisis, 3G scam, coal scam, Fragile 5, demonetization, GST, Ukraine war, Israel war, pandemic. You can think of crises which would have happened, could have come. So uncertainty is the nature of the, this thing, right?
The bad animal.
Always will be there, right? And despite all these uncertainties, India has delivered 15-16% CAGR return over a 20 years period, being the best performing market around the globe. So uncertainty is going to be there. If you are worried about intermittent volatility, you should not be equity investor. But if you look at longer the horizon, lower the risk, as Sunil was saying earlier, right? So currently also, let's say we have been going through the war for last 1.5 years. Why it has not impacted, Simply, historically, wars impacted economies only for one reason, nothing else. Because other than that, no other reason, oil prices, right? War happens, oil price go up and, we start painting. This time around, thanks to our government's bold move of importing oil from Russia, oil price didn't go up. And as a result of that, it didn't impact anybody. But if we, let's say, didn't decide to import oil from Russia, we would also probably be in a different situation. So I think oil price, which is one of the critical factor, is very, very, so hence today ongoing conflict. In general, war is good for business because you rebuild a lot of things and, that happens. And I do believe that with Trump coming in, probably the geopolitical tension will go down. Now, I'm not an expert, but whatever little I understand based on his comments and all those things. So having said that, I think what works for India, and again, the thing we were saying that structurally we are very solid, right? But risk will come. So the analogy I like to give is that if my vitals of my body are strong, which is the 5 factors I said, viral attacks will happen. If viral attack happens, I will be down for 2 days with fever, but I won't be ICU, I won't go down. Same way, our vitals of our economies are strong. These externalities might bring little bit of volatility in the market, but eventually we'll come back. We had SVB crisis, Silicon Valley crisis, we had Ukraine war. Markets react and then come back because our vitals of the economies are strong, our structural growth is strong, our drivers of the stock growth are very strong. So I think that is the perspective every investor should keep in mind. Whenever there is a little bit of crisis, risk comes. And by the way, risk always comes from, if you ask me what are the risks, I can give very intelligent sounding answer. But risk always comes from sources you don't expect, and it always comes when you don't expect. Unpredictable. I mean, it's nice to predict, but it is unpredictable, right? So all you can do is prepare it through the quality of the portfolio, quality of your investments you do, and then live through the volatility as and when it comes, and keep the horizon long. That is the at least perspective I have.
Okay, Mr. Jan, before you throw it open to the audience, your perspective on how serious is the external sector challenge. Mr. Kamani is suggesting, and justifiably, that uncertainties have always been a factor to be considered. So, do you think that the current spate of uncertainties arising from these conflicts should worry an investor in terms of India premium?
No, I think I agree with what Vikas said, that there have always been external challenges of some sort or the other, and they have seldom impacted India's economic growth, except when oil prices spiked up. And fortunately, this time oil is quite reasonable. So I don't expect the economy to suffer. India has structural growth drivers, and this growth should sustain. In the past, our markets have suffered around crises like 9/11, Lehman, tapering, COVID. I think this time around the impact on markets should be much lower, because this time around the domestic flows are very structured, and we have seen the clear evolution of the domestic investor. In 22 and last month, I mean, these periods saw massive selling by FIIs, but the local flows are quite structural. So I think the impact on markets this time around should be even lower, and that is visible in if you look at the last 20-year plot of India's volatility, it is structurally on the way lower.
Okay, wonderful. Let's have some questions from the floor. Please go ahead. Please identify yourself and ask a question if you don't mind. Yeah.
Sir, this is Shweta Singhal from Millennium Mams. It's a non-profit for women empowerment. The question is for Mr. Jain. Sir, you mentioned about consumption will be in moderate, to expect consumption to be moderate. Could you elaborate on that? Why do you feel so?
Mr. Jain.
Madam, all I said is that the consumption last few years has been supported by rising household leverage, small ticket loans, not the home loans. So when you are growing ahead of your income growth, supported by EMIs or whatever loans, there is a limit to how much leverage you can run, and a stage comes when that leverage becomes unsustainable, and there will be a correction phase. So I am not saying that consumption will not grow in India. It should certainly grow, right? It should grow faster for consumer discretionary products and less for staples. But in the near term, as you can see in the growth of small personal loans, that's slowing down very sharply. Central Bank has been writing about it. So I think consumption will grow, but we should not expect it to grow at a rapid pace.
Okay.
And see, 6, 7, 8% growth longer term in real terms is a very healthy rate of growth.
Thank you.
Any other questions? Yeah, please. Please identify yourself.
Hi, I'm Sameer Agrawal. I'm an investment banker by profession.
Sure.
A question to panel members. We have seen in last budget, government tinkered around with the taxation rates on stock market returns, capital, short-term, long-term. How do you foresee this as you all run a large PMS? How does it impact investor sentiment, short-term, long-term? And is it good to tinker around with rates, or is it better to have a steady state so that people are aware that what kind of returns they're going to generate?
Mr. Kamani, you have a chance to criticize the government now.
Well, all of us want zero tax, but fact is that that's not going to happen. We had a zero tax earlier. It came 10%, then became 15%. So I think if you are making money, we should pay tax. I have no reason to believe that why should we not pay tax, because we have to contribute back to the economy. Of course, to create culture of equity, government supported for a very long period of time equity culture, which I think has worked very well. So I think now ideally I want 10%, 15%, right? Ideally, if you ask me, I don't want the tinkering around to be happening. But I'm saying government has its own approach and policies, and only thing I would say, make it simple. What is this long-term, short-term? Just have one rate and finish it off. Whether it is 12%, 15%, take one rate and just say finish it off, and then continue that for a very long period of time is what I would say. But my core philosophy has always been, भाई मधुमक्खी शायद है तो मधुमक्खी आएंगी. अगर पैसा बनेगा तो हम लोग सब आएंगे मार्केट में. पैसा नहीं है तो as long as markets are giving returns, all of us will invest, whether tax is 15%, 20%. Now post-tax return across all asset classes will determine like we have seen why money is not going to bank deposit, because post-tax return doesn't make sense to deposit. So that government is discouraging, according to me. If you ask me, ideally I would want government to encourage that part as well, because this is also creating a lot of dilutes of flows towards equity market. The balance of both is required, and my expectation was that government probably would give some incentives to the fixed income so that the post-tax return doesn't become abysmally low.
Yeah, I'm sure the finance minister is listening to you, Mr. Kamani, and this is being webcast live. So please, next question.
Hi, this is Yasser Pitalwala. Sunil, you mentioned that essentially equity investors are partners in the business. Now, when we are seeing stake sales by the majority owners, it's not dilution to raise capital. What is it that the controlling shareholders know that minority shareholders don't know?
See, I think there are many considerations which go when any shareholder, whether majority or minority, decides to invest or disinvest. I think there are companies where maybe, there is not the next generation which is interested in the business. I think that is motivation. There are a lot of times the price offered is so exciting in the near term that you end up selling. And I always give this example, at least I have grown up drinking Thumbs Up. And that company was sold at 300 crores. At that point of time, 300 crores was a huge sum. Today, Varun Beverages is what, 2 lakh, 2.5 lakh crore without its own brands. So, sometimes the price offered in the near term is so mouth-watering. See, ultimately we are human beings, boss. भगवान ने हमको सब कुछ दिया है, but और भी गुण दिए हैं ना, लालच और ये और वो सब, तो कभी-कभी हो जाता है वो. Obviously, this huge selling by promoters and, majority shareholders is a little bit disturbing. And frankly, I am a little bit put off by foreign companies coming and dumping their stake here. So car company came in, the Indian government had offered them land at 1 rupee. अभी उन्होंने यहाँ फैक्ट्री लगाया, बोरो भी हमारे पैसे से किया, बेचा भी गाड़ी हमको, and they have taken $3 billion away from this country. But we are in a connected world. We can't say we will not allow this, we will not allow this. नहीं तो P जो 20 का है वो 10 हो जाएगा. So I think we have to live sometimes with this. As an investor, आपको तो choice है ना, 6,000 company listed है. If you are not happy with someone selling stake, don't buy their company. There are so many others. But we have to accept that in a world, everything is not ideal and everything has a different reason. And we should not even go into that reason. We should just be ourselves in terms of determining whether we want to invest or not.
Okay, we are running out of time, so I think we will take that question. Yeah, please.
Hi, sir. This is Balram here. I have a small question. We have been talking about this equity market. Is it in a bubble phase, or is it the premium justified? Also, we do hear that Warren Buffett, he is also sitting on $235 billion, and also here.
Yeah,
AMCs,
come to your question, please.
Yeah, AMCs are sitting on cash. So, is it the right time for the retail investors to sit for some time and look at the market, then enter? Thank you.
It's advice on what he should do with his money. I'm sure he's sitting on some money. So,
my view is, boss, and I think I can add that पैसा कब invest करना है जब आपके पास हो. Because ultimately, if you have a long-term, 5, 10, 15 years horizon, like all of us said that India is one of the best growth market. You can't compare with US and take decisions on India, right? US as a percentage of world GDP, US market cap as a percentage of world market cap right now is 62%. India is at 3%. So I think US consideration and India considerations are very different. And I mean, if you are a long-term investor, you can invest anytime, don't worry.
okay, we'll come to the end of it, but I had 3 quick fire questions to each of you, one each. And you have to give a very quick, short answer. To Mr. Jain, sectors you must avoid.
I would be cautious on small and mid caps in general, not in individual companies, but in general I would be cautious.
Okay, Mr. Kamani, do you believe there is froth in the small and the mid cap segment?
Depends on what you're looking for. There are definitely pockets of excesses. There's no doubt about it, and one should avoid them. But in small and mid cap also, there are extremely great companies right now, which we are invested fully, I can tell you, in small and mid cap, and where we have confidence that they will become bigger from here.
Okay.
So
Okay.
it's the pockets you have to identify. Don't invest in the fads,
Okay.
and don't invest out of FOMO is what we say.
Mr. Singhani, my final question. Is there any domestic issue that worries you?
See, issues will always
Domestic
be,
issue.
Yeah, issues will always be there. But at least on the macroeconomic front, I don't think there are any issues which worry.
Non-macroeconomic front?
That will always be there,
Okay,
Yeah,
okay.
but
Okay,
because
I
we are
think,
we are in the midst of conflicts across. So, but it's like a sigma 8 sigma 10 sigma event.
Okay. I think we had a lovely interaction, and the market gurus were not just playing the role of a market guru, but they were frank, they were open, they took all your questions, and with the clarity, with the frankness that I think few market gurus show. Once again, thank you very much, Mr. Jain, Mr. Khemani, Mr. Singhania, for being there.